Today, I want to share with you some powerful strategies to boost your income and grow your wealth through investments. In today's fast-paced world, relying solely on your paycheck is no longer enough to secure your financial future. Investing wisely can create new income streams and help your money work for you. Whether you're a beginner or someone looking to optimize your portfolio, these 10 methods will guide you towards financial growth and stability. From understanding the basics of different asset classes to adopting smart habits, each strategy is designed to help you build wealth steadily and confidently. By applying these approaches, you not only increase your income, but also create a lasting financial foundation that can benefit you and your family for generations. One of the most fundamental principles of successful investing is diversification. Simply put, diversification means spreading your investments across a variety of asset classes, industries, and geographic locations. The idea is to avoid putting all your money into one type of investment, because doing so exposes you to higher risks if that single investment performs poorly. By diversifying, you reduce the impact of any one loss on your overall portfolio, thereby protecting your wealth and creating a more stable foundation for long-term growth. When you diversify, you're essentially balancing risk and reward. Different asset classes, such as stocks, bonds, real estate, and commodities respond differently to economic changes. For example, stocks may perform well during periods of economic expansion, but can be volatile during downturns. Bonds, on the other hand, tend to be more stable and provide fixed income, helping to offset stock market fluctuations. Real estate investments might generate steady rental income and appreciate in value, offering another layer of protection. By holding a combination of these, you position your portfolio to withstand various market conditions. Within each asset class, further diversification is also important. For stocks, this means investing in different sectors like technology, healthcare, energy, and consumer goods, rather than concentrating all your shares in one industry. Geographical diversification can also be advantageous. Investing in international markets opens you up to growth opportunities in emerging economies while spreading risk away from your home country's economic cycles. This approach helps prevent your portfolio from being overly affected by region-specific events like political instability or economic recessions. Diversification isn't just about spreading out your investments randomly. It requires thoughtful planning and regular portfolio reviews. Your investment mix should align with your financial goals, risk tolerance, and investment horizon. Younger investors with a longer time frame might afford to take on more risk with a higher allocation to stocks, while those nearing retirement typically benefit from a more conservative approach with more bonds and income-generating assets. Regularly rebalancing your portfolio, selling assets that have grown disproportionately and buying those that have lagged, helps maintain your desired risk level and keeps your investments on track. Finally, diversification also involves considering alternative investments beyond traditional stocks and bonds. This could include assets like real estate investment trust rates, commodities like gold or oil, and even newer options like cryptocurrencies. While these alternatives may carry unique risks, they often behave differently than traditional investments, further smoothing out the ups and downs of your portfolio. By building a well-diversified portfolio, you not only protect yourself from sudden market shocks, but also create multiple pathways to grow your wealth steadily over time. Compound interest is often called the eighth wonder of the world for good reason. It refers to the process where the interest you earn on an investment is reinvested, allowing you to earn interest on both your original principal and the accumulated interest from previous periods. This snowball effect can cause your wealth to grow exponentially over time, making compound interest one of the most powerful tools for building long-term financial security and wealth. Understanding and leveraging compound interest can dramatically change the way you approach investing. The key to harnessing compound interest effectively lies in time and consistency. The earlier you start investing, the more time your money has to grow and compound. Even small contributions made regularly can multiply significantly over decades. For example, if you invest a modest amount each month in a diversified portfolio that earns an average annual return, those contributions combined with the compounding effect can turn into a sizable nest egg by retirement. Delaying investment, on the other hand, means missing out on years of compounding growth, requiring you to invest much larger sums later to reach the same financial goals. Another critical factor is reinvestment. To maximize compound interest, all earnings, whether dividends, interest payments, or capital gains, should be reinvested rather than withdrawn. Reinvesting allows your returns to generate additional returns, accelerating the growth of your investment portfolio. Many investment accounts and funds offer automatic dividend reinvestment plans, making it easy to keep your money working for you without having to think about it constantly. This disciplined approach of letting your investments grow uninterrupted can have a huge impact on your wealth accumulation over time. Compound interest also highlights the importance of patience and a long-term mindset. Unlike quick profit schemes or short-term trading, compound interest requires a commitment to staying invested through market ups and downs. There will be periods when your portfolio may not grow or may even shrink temporarily. But if you remain patient and continue investing, the power of compounding will help your portfolio recover and grow over time. This long-term approach reduces the temptation to make impulsive decisions based on short-term market volatility, which can be detrimental to your overall financial health. Lastly, compound interest is a reminder that financial growth doesn't have to be complicated or dependent on luck. It is a natural mathematical principle that rewards time, discipline, and consistency. By setting clear financial goals, making regular contributions, and allowing your earnings to compound, you can build substantial wealth over the years. This method works for all types of investors, regardless of the amount they start with, making it an accessible and effective strategy for anyone serious about boosting their income and growing their wealth through investments. One of the most effective ways to boost your income and build lasting wealth is by focusing on income-generating investments. Unlike growth, only assets that rely solely on price appreciation, income-generating assets provide you with regular cash flow, often in the form of dividends, interest payments, or rental income. This steady stream of earnings can supplement your salary, cover living expenses, or be reinvested to further accelerate wealth accumulation. By prioritizing investments that pay you regularly, you create multiple income streams that make your financial situation more resilient and diversified. Dividend-paying stocks are a popular category of income-generating assets. These companies distribute a portion of their profits back to shareholders, typically on a quarterly basis. Dividend stocks not only provide regular income, but can also offer potential capital appreciation, making them a valuable component of a balanced portfolio. Many well-established companies have a history of steadily increasing their dividend payouts, which can help protect your purchasing power against inflation. Choosing dividend aristocrats or companies with strong fundamentals can ensure that your income stream remains stable and grows over time. Real estate investments are another powerful way to generate consistent income. Rental properties can provide monthly rental payments that create a predictable cash flow. Unlike stocks, real estate often benefits from both income generation and property appreciation, giving investors two ways to build wealth. Furthermore, real estate investments offer tax advantages such as depreciation and deductible expenses, which can improve your net returns. Whether you choose residential, commercial, or vacation properties, investing in real estate can diversify your portfolio while providing a reliable income source. Fixed income investments such as bonds, certificates of deposit CDS, and peer-to-peer loans are also essential income-generating options. Bonds pay interest regularly and are generally less volatile than stocks, making them ideal for investors seeking stability and income. Government and corporate bonds come with different risk and return profiles, allowing you to tailor your fixed income investments to your risk tolerance and financial goals. Peer-to-peer lending platforms also offer attractive interest payments, though with higher risk. Incorporating these fixed income assets in your portfolio can help balance risk while ensuring you receive periodic income. Lastly, it's important to consider alternative income-generating investments, which may include real estate investment trusts REITs, master limited partnerships MLPS, and even certain types of mutual funds or exchange-traded funds ETFs focused on income. These vehicles often provide higher yields and easier access to diversified income-producing assets without the need to directly manage properties or loans. They can be especially valuable for investors who want to generate income but lack the time or expertise for hands-on investment management. By including a mix of these income-generating assets in your investment strategy, you build a more robust and reliable financial foundation. In the world of investing, knowledge truly is power. The financial markets are dynamic and ever-changing, influenced by economic shifts, geopolitical events, technological advancements, and regulatory changes. To make smart investment decisions that can boost your income and grow your wealth, it is essential to continuously educate yourself. Staying informed about the latest trends, strategies, and tools will empower you to navigate the complexities of investing with confidence and avoid common pitfalls that can derail your financial progress. Continuous education starts with building a solid foundation of financial literacy. This means understanding the basics of how different investment vehicles work, including stocks, bonds, mutual funds, real estate, and alternative assets. Learning about concepts like risk tolerance, asset allocation, diversification, and tax implications will help you create a strategy tailored to your unique goals. There are countless resources available today, from books and podcasts to online courses and webinars, that make it easier than ever to develop your investment knowledge, regardless of your starting point. Beyond the basics, keeping up with market news and economic developments is crucial. Changes in interest rates, inflation, government policies, and international affairs can significantly impact your investments. Following reliable financial news sources and expert analyses allows you to anticipate potential risks and opportunities. It also helps you understand market sentiment and investor behavior, which can be invaluable when deciding when to buy, hold, or sell assets. This ongoing awareness helps prevent costly mistakes driven by fear, greed, or misinformation. Another important aspect of continuous education is learning from your own experiences and mistakes. Investing is not a one-size-fits-all endeavor, and every investor's journey is unique. Reflecting on your past decisions, analyzing what worked and what didn't, and adjusting your approach accordingly will make you a wiser and more disciplined investor over time. Additionally, networking with other investors, joining investment groups, or consulting financial advisors can provide diverse perspectives and insights that enrich your understanding and help you refine your strategy. Lastly, the commitment to lifelong learning is a mindset that sets successful investors apart. Financial markets evolve, new investment products emerge, and personal circumstances change, all requiring you to adapt and grow. By regularly dedicating time and effort to enhance your financial education, you stay ahead of the curve and maintain control over your financial destiny. This proactive approach not only boosts your confidence, but also positions you to capitalize on emerging trends and maximize your income and wealth growth through investments. In conclusion, boosting your income and growing wealth through investments is a journey that requires strategy, patience, and continuous learning. By diversifying your portfolio, leveraging the power of compound interest, focusing on income-generating assets, and committing to ongoing education, you set yourself up for long-term financial success. Remember, building wealth doesn't happen overnight, but with consistent effort and smart decisions, you can create a secure and prosperous future for yourself and your loved ones. So take action today, stay informed, and watch your financial goals become reality.